Okay, great. I'm just gonna pull up the screen. Can you see it? Shruti, you can see the screen?
Yes. Yeah, it's visible.
Okay, great. So I think you'll have had a couple of sessions so far. Hope it's been useful. I know some of you are setting up or already have operations running, starting. So let's just dive into this today. Actually, I don't know if you all remember, but I used to work with an investment bank earlier. So I used to work with startups. I literally used to help them build out their financial models. So right from teams which were like 25 people to teams which were 100 people. So yeah, hopefully some of the points that I cover here will be useful for you all. So we'll cover a few different aspects of financial planning today. We'll talk about planning, we'll talk about budgeting, few of the key things to keep in mind so that you avoid significant errors while planning and budgeting, and what are the key KPIs you need to keep an eye on, and you need to communicate, whether it's to your stakeholders or whether it's to your potential investors. Okay, so what is financial planning and budgeting? So planning, I mean, maybe I can go around here. If you ladies have teams in place, what are the kind of sizes that y'all are at currently? If anyone wants to come in and, is anyone here? Do you all already have operations up and running? I can't seem to recall right now.
Sorry, I cannot hear you very well. The voice is going.
Can you hear me now? Maybe I need to be
Yeah,
a
but your voice is fading. Like it's there and then it's not there. Sorry about that.
Oh, really? Shruti,
Yeah.
can you hear me or?
Yeah, you are audible now. Better.
Okay. Is it fine now, Kavita?
Yeah, I can hear you now. Yeah.
Okay, so I was just asking if we can, quickly go around the room and kind of talk about what everyone's team size is, if you all have already set up your company and have operations in place. No?
Yeah. Sorry. So my experience is, we're doing. I'm like completely not from financial background, completely like scientific background. But
Yeah.
lately I've been doing the financials for the company.
Okay.
I mean, a CA is handling the, the yearly, whatever financials like balance sheets, P&L, and I review them just to understand. And then we're trying to come up with a valuation for the company. So trying to understand what multiple we can use, the discounting method and the NPV, different strategies to find the valuation of the company. I think very basic, I guess.
Yeah. Actually, DCF is not so basic, but yeah, we'll come to that. It's quite difficult to value a very early stage company using DCF just because there's not much historical numbers to go by to really build out that valuation multiple, right? But we'll come to that in a bit. So yeah, two key aspects, planning and budgeting. Planning, of course, involves, as you're growing out your teams, as you're growing out your operations, you're going to have different heads. So you need to understand how much you need to budget, how much is going in, what is the cash flow that's coming in, is there a negative cash flow, when do you need funding, how much funding do you need, and if you do get that funding, whether it's equity, whether it's debt, if it's debt, you're going to have to service those costs. So you need to build this out, and if you have your numbers in place, that can help you with your valuation, because at the end of the day, especially at such an early stage, not everyone has a CFO, right? We are working with a CA, but at the end of the day, you are the key person who's going to be responsible and accountable, right, for your projections and for all the numbers that you're putting into your financial model. So yeah, let's talk a little bit more about this. Okay. So there are two things. One, even if I guess you've just started operations, you might not have, like, I think most companies, you know, when they build out their financial projections, you also have historicals for 5 years, but that's okay. Early stage companies, people understand. So even if you have just maybe a few quarters, if you've just started operations, or if you have a year, a couple of years, that's totally fine. It's good to have and, you know, keep track of this. I know that in the beginning it's hard, and you also kind of, you're just starting to work with a CA, just starting to get all your numbers in place, plan out what heads different expenses come under. So yeah, super important, because having these historicals in place and seeing the trends is what is actually going to help you build out these numbers going forward, right? Your projections, your growth rates, your assumptions for these growth rates. And you need to be able to back up these growth rates by your past trends. So super important to have all this in place. As I mentioned earlier, at the beginning, the first few years, you're going to have to be fully accountable for your numbers. The CFO and the big folks, they come in later when you can, one, afford them, and two, you need to sort of focus your bandwidth on the operations and the other parts of what your company is doing, right? Yeah, so once you grow, same point that I was making, once you grow, once you have other teams, you're going to have to look at so many other aspects. So that's when you can really bring in someone senior to look at this. Okay, so I know Kavita mentioned that, you know, she was planning to, or she's in the process of finding out what she can value her company at. So that's where financial modeling comes in place. You have your cash flow analysis. You can do scenario testing, because a lot of all of these things are based on assumptions, right? So something that you think is an okay projection or an okay growth rate to put, the other party might not agree to. So there's going to be different scenarios that you're going to have to test under, a conservative scenario, possible scenario, highly probable scenario, and a very aggressive scenario. So it's good to kind of see that sort of range, worst case scenario, best case scenario, and, you know, a conservative number. And usually what we kind of put out to the external parties, whoever it is, stakeholder, investors, should be somewhere in the middle. That's what they've generally gone with. But we also show like a small sort of scenario testing where there's a range. It's good for them to also know the worst case scenario in case, you know, like we had COVID. So if something else, some big shock comes along, what is the possible worst case scenario? Implementing monthly, quarterly, and annual growth strategies. So this is another thing, especially when you're early stage, it's good to have monthly, quarterly numbers. Once you have, you know, years of historicals in place, then building out that annually makes more sense. But even what I've generally done with very early stage startups is I start with monthly, and for historicals, if there's about 3 years, then I make it quarterly. And then going forward, I generally build it out annually, if it's 3 to 5 years. But again, it really depends on what stage you are at. So a good rule of thumb is to kind of do quarterly. And then in the summary sheet, you know, just add it up and show the annual numbers on a separate sheet. Okay. Some heads to keep in mind. Plan for all costs, of course. You're going to have multiple heads. So how we generally, I don't know, maybe Kavita, you've seen the P&L and you're comfortable with it. So there's always you're going to start with the revenue coming in, right? And then you have all of your direct costs, and below that you have your net profit. And below that is when all of your, you have your gross profit. Then below that is where all of your variable costs come in. You might have your variable admin, you have your marketing, which could go up and down. You have rent is of course fixed. So yeah, you really need to understand what is fixed, what is variable, and then build out projections based on this under separate heads. Even team costs, it's again easy to build out when you're a small team and you're looking to build out stuff for maybe a 25-member, 50-member team for the next couple of years. But when I've worked with companies and who have had like 100 employees and have been looking to expand to 500, 700 employees, we've literally built out we have a entire separate sheet on the model for this. And we break down the entire organizational structure, and under each department, how many people, what are their designations, and right from the junior most person to the senior most person, we build out their CTC and build out that entire HR sheet. So all of these things, become more and more important as you grow. Escalations, of course, certain things like rent is going to increase, admin, if you're going to grow, it's going to increase, software costs, technology costs. So yeah, important to keep track of all this. And if these are not things that you're on top of, then at least have a CA in place who can help you out with this. But yeah, at the end of the day, it's always good for you at this stage to know and oversee and review. So yeah. Any questions so far?
Yeah. I wanted to raise one question. So we applied for a bank loan like 2 years back, and then that's when we did the financials ourselves. And we got a template from the bank, which was very complicated. It was like in 4 different sheets of, we had to calculate all the ratios of like, the debt coverage ratio and, lots of things. And and then see now, so that was one part. I think, for early stage startups, that'll be very important. We could have, used a CA to do that, but we decided to do it ourselves. We learned a lot. Our bank loan got approved, but that is something that I feel like a lot of people will be doing in the early stage startup, applying for a bank loan. So doing the financials for that. And second one would be, the thing I struggle a lot with right now is whenever we are pitching to investors or VC firms, they're asking for IRR. And that is something, if you can touch on as well.
Right. So one, I think for your business model, this is Elements, right? Kavita?
5 Elements, yeah.
Correct. Yeah. So I remember we chatted earlier. I don't know if not all startups, early stage startups are suitable for a bank loan. Most of them, I know you have hard collateral. So, banks coming in, your business model, it makes more sense.
I see. Okay.
Yeah. So yeah, their sort of models are always complicated. You're going to need all those ratios. They're going to need, to understand what your cash flows are, when it's coming in, all of that. VCs look at it differently. And I know you mentioned DCF. Maybe quick question. How many years have you been in operations?
So we started operation we got the loan in 2020. We were building the plant and we started operation in 2022, January 2022. Okay.
Yeah. Okay.
And yeah, it is the phase where the plant is getting stabilized. So there is some revenue for sure, but it's not a stable revenue. But it's coming in, and it's increasing over time. So that's good.
Right. Yeah, I mean, so to maybe answer your question here, for VCs, generally work on a revenue multiple or an EBITDA multiple. It's pretty simple because again, you said 2022, so there's not much history to go back on. DCF, usually it's PE firms who do it with startups who've been around for a while. It makes more sense there because you actually have growth rates for, say, at least a decade at a minimum. So I don't know how useful it would be to do the DCF. You can do it in any way, but VCs don't really, in my experience, I've not seen that. It's usually just a multiple. So as long as you have your historicals in place, you have your projections for the next 3 to 5 years, based on that is generally what they bring up the multiple on.
Okay.
Yeah. Okay. Hi, Nalin.
Hi, everyone. Sorry, I got late, but you were in very good hands with Ashwati.
Do you want to take over? I don't think I've looked past.
Yeah, it's okay. I can take over. I think you'll have other things to do.
No, yeah, I'll stick around for another few
Okay.
minutes. I just stopped at escalations.
So finish this slide. Sorry. I thought you were done. No, finish this, then I'll comment.
Okay. Yeah, escalations I'd mentioned, contingencies, of course, you have at an early stage, you have no clue what you're going to be spending on in the next quarter, especially maybe if you're pivoting or whatever. So good to include like a 5 to 10% contingency generally. Yeah, break-even point. This is a tough one, but good to kind of understand, even if this is at some point in the future, once you build it out and really get a grasp on, when your cash flows are going to be strong and coming in, this will really help you sort of even plan your fundraising and even understand where to kind of, okay, I can have this much equity, maybe this portion, 25 portion I can cover with debt. So yeah, good to have a grasp on all these things. And yeah, I mentioned this throughout in the last few slides. Everything is based on assumptions, but as long as you can back it up, that's all that matters. Everybody understands, all stakeholders at this stage, they understand that, everything is based on assumptions. As long as you can back it up, you're good. Okay, maybe I'll stop here and hand it over. Nalin, do you want to share from your screen?
Yeah, I'll share. So if you wanna, so Meenu has a question on break-even point. Yeah. So you want me to take this?
Sorry. Question?
Yeah, she's asking what is break-even point?
Oh, okay. Break-even point is basically the point at where you're going to cover your costs. Right? So how much you're spending and how much you're at the point where cash flows are enough to cover all of your costs and you're not at a loss.
Yep. Okay, good. All right, thank you, Ashwati. So at the risk of repetition, can I just ask amongst the 5 of you, Anusha, Meenu, Kavita, Kasturi, and Shobha, if you want to just do a raise of hands and tell me if you have any exposure to financial analysis or modeling, or if you have even a financial model that you built for your company or in the past, that's also fine.
Hi, sir. Good evening.
Hi.
Hi.
Yes, good evening.
So, sir, ये मेरा co-founder जो है विमल पंजवानी CEO वो देखता है ये financially.
अच्छा, ठीक है. तो वो करते हैं, है ना? तो आपकी कंपनी में कोई करता है फाइनेंशियल एनालिसिस?
हाँ.
ठीक है, गुड. And accounting and all, who does? Like cash management, accounting.
firm, sir, firm करती है firm.
कौन?
Firm.
Firm.
Yes.
मतलब an external firm, someone externally is what you're, बाहर, मतलब you contracted someone to do it.
Yes.
Okay.
Yes.
नहीं, but cash management तो आपको खुद करना होता होगा ना, आपकी how
Yes.
much cash is coming in,
दोनों
how much,
दोनों वो दोनों करते हैं.
आप नहीं करते?
Yes.
आपको पता होना चाहिए ना, आपको पता होगा कैश के बारे में, cash position in the company. For example, how much cash I have today,
सर
how
हम
much I'm
दोनों
going to have.
yes हम दोनों ही करते हैं.
आप दोनों ही करते हैं, ठीक है,
Yeah.
that's fine. ठीक है, good. All right, so Meenu is saying not really. Anusha is saying never did before. Okay, Kavita, Kasturi, what about you guys?
So yeah, I did get exposed to a lot of it. I am a scientist, but we did
Okay, good.
I was just telling before, we applied for a bank loan 2 years back, and we did all the financials ourselves. So that was one,
Right.
and then second, yes, we do have a CA who does the P&L balance sheet, and
Sure.
so with the I do review them, and we are also
Okay,
doing a
good.
provisional right now, and then
Very
yeah,
nice.
we have to do a financial modeling for all the clients that we're selling the plants to. So we need to
Yeah.
give them an idea of, how much this revenue this plant will generate, what are your fixed
Yeah,
cost
yeah,
and
yeah.
variable costs and all that. So that's some. So I
Okay,
do
good.
have some understanding. That's it, but not a
I think
lot.
I think you have a pretty good understanding since you're talking about provisional balance
Mm.
sheets and statements. So good.
Yeah,
So you have a
but
pretty
what
good
I struggle
understanding.
with, sorry,
Ah.
what I struggle with is calculating the IRRs and the valuation of the company,
Yeah.
and that's what I raised the question in the beginning.
That's okay. That's okay. So that everyone struggles. It's unfortunately more of a craft oftentimes than a science, you know. So it's okay. Okay, good. So we have fair amount of comfort. See, the main thing about these things is once you've gone through it, you are no longer apprehensive about it, and that's the main thing. You know that it's something it's certainly not rocket science. It's, in fact, it gets more interesting the more you practice it, almost, and especially because it's a live thing, it's your own company, it's even more interesting. But here, let's focus on a few concepts. So let me come back to the deck. What we've gone through is, of course, looking at key points in financial planning. Now we can look at certain things that we can avoid, certain mistakes, and perhaps also some idea on how to avoid them. Right. Okay. So one thing which oftentimes we are all kind of, we all fall prey to is perhaps underestimating costs, and sometimes even overestimating costs, which do you think is the worst one, underestimating or overestimating costs?
Underestimating.
Yeah, normally, yes. I mean, even overestimating costs is not right, but underestimating costing is definitely the worst one here, right? And that's oftentimes not an intentional thing. You may not have thought of things, right? And cost of sales is a good one to think about as a conceptual framework, and we'll go through. Not in this, we won't go. I don't think we'll go through in this presentation, but just imagine you have uh, 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 right, you have to calculate the customer acquisition cost, right? So the way you would do it is the right way to do it is to see the total number of leads you've reached out to. So that's taken some time, and eventually the number of clients you finally converted, right? So let's say you reached out to 100 people, right? It's taken you on average 30 minutes to reach out, to identify the company and identify the right person. So there's a bit of research involved. So there's about 50 hours of work that's gone into that, right? Of them, 2 become your clients, right? I'm talking about a B2B conversion ratio, 2 become your clients, right? And for those 2, you spend another 3 or 4 hours each in making that conversion, right? And then you have to add on your other costs, other time costs, right? Travel, etc. So let's say on average, you spend 10 hours to convert one of them, right? So 20 hours to convert and was it 50? Yeah, so maybe 50 hours to reach out to the 100 that you converted, right? So overall, you spent 50 plus 20, 70 man hours to get 2 clients. So your cost of customer acquisition was the cost of those 70 man hours, right? Divided by 2. We have to consider the cost of reaching out to those 100. We can't just look at the cost of finally reaching 2, right? So those are the costs of sales that you have to consider in full, as an example, right? So one is not considering, you've considered all the heads, but you haven't considered full cost. The other point is not considering all heads, right? So you may forget, for example, to consider the costs of annual registrations, annual licenses, IP costs, registration, etc. Maybe also some consultant costs that you may need. So those are heads that you may forget to consider, but it's a good idea to consider, right? This is a very hard one. In fact, there's research that suggests, and I'll bring in Shrishti, because Shrishti done some actually research on the effect of delayed payments on SMEs at the India level, if I'm not wrong, right? For
Hi.
SMEs specifically.
Yes. So yeah, I mean, so we estimated 10 lakh crores as the total size of delayed payments in India. We worked with the data that's available on the Samadhan platform, and some amount of TREDS information also was available to us. So what we did was we sort of we looked at MSMEs. So micro enterprises saw the largest amount of delays. So longest delays, they were around 84, 85 days, despite payment terms being around 45 days for all of them. Small enterprises saw, I think, around 60 days. And the medium enterprises also saw around 45 to 60 days. So it was also about, so our report was also about the negotiation part that you have as the size of your enterprise. Like the micro enterprise has zero negotiating power with its larger clients. So yeah, if you're interested, you could look through the report. We'll share that at some point. I'll send it to Shruti. Maybe she can share it with you at some point. But yeah. Yeah, and another thing about this was that most PSUs, actually all PSUs are mandatorily required to report these delays in their financial reporting. So you'll find it across all of their annual reports.
So
yeah.
for them, what the only metric they need to know is what is the delay that they should consider, right?
45
Isn't
days.
that 45 to 45 days, right? So delay. So that's you have a working capital cycle and then you add delay. So I think that's the key bit here, right?
Yeah.
Good.
And
So,
the 45 days is just, sorry, it's just an arbitrary date, so that we don't want that delay to be beyond. You set your own payment terms. So if it's 15 days for your business, 45 days is what the law says you're definitely being delayed. I mean, your payment is definitely being delayed after the 45th day. But if your contract terms say for 15 days, then that's what your delay is. Your payment is delayed on the 16th day then. So if you're working on the working capital, I would imagine you'd look at it from that point.
so if from day one of invoicing, right, if they have a 15-day payment cycle,
Yeah.
should they assume that the payment will come in 15 plus 45 or T0 plus 45?
T0 plus 15. If the
But then where's the
payment
delay? But
16th onwards. So
no, so okay, so I'm if I am a modeler,
Yeah.
I'm going to assume 15 days, but in reality, the delay is much more, right?
Yeah.
That's what I'm saying. So we model in something more than 15 days. Hannah?
Yeah.
So maybe just T0 plus 45. I'll tell you my own example. In wind, we had a 45-day payment cycle on paper. It was 17 months of delays, 17 months, right? So that's the kind of delay that a business can't handle. It's as good as an NPA, so you're basically infusing equity to cover the gap between what your cash flow is and what you need to pay for example, for debt servicing, right? Or in your case, perhaps, paying other vendors, etc. So this is a very tricky one, the delay in payments, but what you should do is be extremely conservative here, right? Shishti mentioned 10 lakh crores, that's almost 4% of India's GDP. It's a major problem, right? Most things are not 4% of India's GDP. Our defense budget is less than 2% of our GDP. Our healthcare budget is less than 1.5%. It's a massive resistance in the monetary system in India, right? So you're part of it, whether you like it or not. So consider that when you model it in. The other small thing is, of course, considering revenue is cash flow. Now, I say this now, in many cases, if you don't have debt, your revenue could, your net profit could be very similar to your cash flow, as long as you don't have depreciation expenses, right? But certainly people tend to conflate revenue and cash flow. That's not something you should do. Any of you who've done any level of financial modeling or analysis know this to be true, but just pointing it out that some people do confuse these two things. The other thing is LOIs and purchase orders. There's sometimes, I mean, big companies do this also. They get creative in when they book revenue. And that's for other reasons, they have to show growth and all of that. But LOI and purchase orders are different. You cannot use an LOI date as the date when you book income or revenue. Yeah, okay. So in terms of, so a very simple example about assuming all costs, right? And let's assume the cost of hiring, right? So what does salary include? Yeah, and what does cost to company more specifically? So salary is there. Then anything that helps the employee accomplish the work that you set them out to do. It could be a laptop, it could be desk space, it could be other insurance, it could be health insurance. Can also be, depending on the size of your company now or later, gratuity and provident fund, etc. Right? And the other thing, of course, is the time spent in hiring. It's again hard to estimate. I don't know the team size you have, but you may be yourself doing it. You may be doing it through an HR person you've hired or an HR agency you've hired, whatever it is. This is one way to see that the cost of hiring is significant. I have not even included training here. Training is significant management time, but it's high leverage management time, because you train someone for an hour or two, and it might lead to a productivity increase, which is significant over time, and it compounds. Right. Okay, so maybe a few things that we can look at. Yeah, I mean, you should basically, of course, understand what is your bank balance, how much money is coming in, how much money is going out, right? At the very simple level, these are the key things that you should know. This is what cash flow management, this is what will help you in managing cash flow. One thing is to create the projections for the next 3 years, but you have, yeah, real business is much more lumpy. It's much more kind of volatile than the spreadsheet suggests, so. But even starting with just these 3 things, making sure what your accumulated balance is, what your incremental money coming in and incremental money going out is, that's something you should start with, right? there are some things that you see daily, something you see weekly, something you see monthly and quarterly, right? It's a cycle that you should arrive at on your own, right? It also depends on the kind of business that you do. Many businesses have to look at money coming in and out on a daily basis. Some businesses are more lumpy than that, so maybe it's weekly that you need to do. But many of you think if you're doing B2C, D2C stuff, then you'll probably look at money coming in and out on a daily basis, even bank balances on a daily basis. Right. Okay. So key points here is that founders, US founders need to undertake financial planning yourself, which means some level of analysis. Planning for all costs is important. That means considering all costs under a certain head and also considering as many heads as you possibly can foresee. Basis for assumptions, right? I follow these things. I mean, the basis for assumption is the most important. VCs will not necessarily look at, okay, so two things VCs will look at is the basis for assumptions, and two, whether the market that you're operating in is big enough, right? Now, market that you're operating in big enough is a function of several things. Of course, the total market size, but also your ambition, right? You could be a founder that's quite happy being a small player in a big market. There's nothing wrong with that. And you could be also a person who wants to be a big player in a big market or a big player in a small market, right? For the VC, the best bet is a big share in a big market, right? In any case, being part of a big market is important. Unless you're a big player in a small market where you have some outsized advantage, which is likely to stay on, right? And that's typically a deep tech advantage. Even there, it's not clear. But everyone needs to see that you have big ambitions and you play in a big market, right? So big market, big ambition, and strong basis for assumption, very important, right? And just looking at key metrics on a constant basis, right? We discussed daily, weekly, quarterly, but it also gives you some amount of understanding of when you're going to run out of money, and therefore for you to be able to plan either fundraise, whether through equity or debt or whatever suits you the best, right? And generally, ideal case is you have 12 months of runway, and when you reach 12 months of or more, right? But when you reach 12 months of runway is when you start to raise, right? Because it takes time, especially at the early stage. Okay, so I'm gonna stop here. And happy to take any questions that you might have. Thanks, Ashwati. Hey there. Otherwise, we can also break for the day.
Any questions? You can type it in as well. You don't have to speak.
Oh, yeah. Maybe can I just ask, like, whoever wants to, like, what kind of product are you selling or service? Whoever wants
Before
to.
that, Nalin, let me just do a quick introduction for you because you joined in late.
yeah.
So, Nalin
Yeah,
and
yeah.
Shruti are actually part of the capital team at Climate Collective, and Nalin actually heads the capital initiative and is partner in the organization, while Srishti looks over the retail investment side. So that's a bit of a background for you both. And yeah, thank you so much for the session so far. We do have a question, I guess. Yeah. Minu has a
Numbers for
question.
deep tech startup. Yeah, I can show you an example of a model if that helps. I mean, when you say, you mean like a financial model? Is that what you're asking, Minu? Yeah. Okay, I'll show you a financial model. 1 second. Huh? Just give me a second. I mean, just to share, I mean, everyone's model will be different, by the way. Okay, so I'll show you a couple of things. Give me 1 second. Yeah, just to give you a sense, okay? I won't show you a model, I'll just show you conceptually what a financial model will look like. And it doesn't matter if it's deep tech or not. See, ultimately you're distilling down the sales of your product into a financial statement, right? So the part about it being deep tech comes in different ways. We assume different risks, you know. We assume a longer product development timeline. We assume a much longer time till revenue start generating and all, you know. So those are different things. But I'll just talk through. Okay, so this is the types of funding there are, right? So we have equity, which you must have heard of, debt, grants, bonds, which is very similar to debt, right? So only equity gives the holder of equity ownership, right? It's also, as far as financial instruments go, higher risk because you are low in the priority when money has to be returned. But as a return, your risk being high means the returns are also potentially much higher, right? And the way an investor gets back their equity is through dividends, debt through interest plus principal repayments, grants, there's no repayment, bonds is again very similar to debt. Yeah.
Nalin, I have a question here.
Yeah.
What
Yes.
are bonds? One, I don't understand that. And second, something I've heard is mezzanine funding. What is that?
Yeah. So bonds are it's an instrument of debt, right? So debt is typically something you would get from a bank, right? You go to a bank, you say, this is what I do, these are my cash flows. My cash flows after expenses, that means my salary, etc., all of those, and cost of goods sold. There's still sufficient cash flow left for me to service your debt, right? So that's what debt servicing is. Without that cash flow, you'll never be able to raise debt, right? That's why you raise equity. That's why pre-revenue startups raise equity, right? Bonds are similar. It's just that you raise it from a different kind of subscriber, basically, for all practical purposes. You say, and these are not, bonds are typically not for startups, right? This is more of a generic kind of presentation that I had made. So bonds are essentially, typically in India, at least, by large corporates, and they say, I'm going to issue you a certificate. You buy the certificate for $1,000, right? And I will pay you a coupon on the bond every year. It's like debt. So I'll pay a 7% or 8% coupon. That's like interest you get. After 8 years, I will give you back the $1,000 as well. So it matures, right? The other way to do it is
something like
I'll
after
not.
The company. Sorry for interfering. Is it something like after the company goes IPO?
Not necessary. It doesn't have. It's not related to listing. It's not related to IPO. You can issue before that also. Yeah.
Oh, that's interesting.
It just is it because bonds are rated instruments, so you need typically to be large enough to be able to raise money through bonds. Rated as in a third party comes in, like a CRISIL or someone will come in to rate. Yeah. But most bonds are still raised by public entities, like public, when I say public, listed entities. Now there's something called, there's a variation here called social impact bonds. So what these guys do is a large institution raises bonds. These are impact bonds, and then gives it to social impact organization, right? So the organization is still strong, but they are using a much larger intermediary to what is called guarantee that bond repayment. Okay, so this was for solar. We can just move ahead. Okay, so for financial model, there's broadly three things you should understand is inputs, that there's a processing function, and then you get outputs, right? So as a general design principle, keep your inputs in one place, right? The processing should be transparent and accurate, which means someone who's reviewing the model should be able to look at the linked cells. That's transparency. and make sure it's robust, it's accurate, right? Which means it should work accurately for different scenarios, right? Oftentimes, many models, at least when you start them out, they work within a narrow range of inputs, right? But you go slightly out of the range and the model starts acting wonky. So you want to avoid that. So that's what we call robustness check in models. And then you have the output. So as a design principle, they should be easy to understand, should present them in an organized way, right? I'm gonna skip this as well. But this is broadly what a financial model would look like, right? So you have the revenue or income, also called top line, also called turnover, right? So there's various words we use, but for all practical purposes, revenues or income is sufficient and most used, right? From this, you remove, again, conceptually, right? You remove the expenses, right? Expenses could be all kinds. There's broadly two classifications: COGS, cost of goods sold, and SG&A, say sales, general, and admin expenses, right? So you take your total revenue coming in, you remove or you deduct the expenses. What you're left with is your operating profit or EBITDA. EBITDA is earnings, E, before interest, taxation, depreciation, and amortization, right? So from EBITDA, you can remove the depreciation. This is typically on your hard goods, your CapEx, and sometimes, also not sometimes, on your software, etc. So from EBITDA, you take out D and A, so you're left with what's called EBIT. So earnings before interest and tax. From that, you remove the interest payments. For many of you, there's no interest payments because you will not have raised debt. So once you remove from EBIT, for all practical purposes, your EBIT and profit before tax is the same, right? From this, you remove your tax liabilities and you come to PAT. PAT is profit after tax, also known as your bottom line, right? So this is conceptually what your P&L, your profit and loss statement looks like, right? Now, okay, so I won't spend again too much time, but your revenues can be broken down, and these are where your assumptions come in, right? We've spoken about assumptions. Now, how do you calculate revenues? It's your calculation of your total sales, your total your assumptions on customers, number of customers, your assumptions on growth rates of customers. What is your unit price? Again, making sure you've captured all the price, all the cost in your of your product, plus the margin, which gives you the price. You've done it for all your entire product range, maybe several products in your kind of inventory, and then you also have to assume some level of year-on-year price escalation because cost heads go up, right? So these are the assumptions that will come here. Kind of leading on from this point, unit price of product, right? We come to what that might be, right? So you have your product cost, your packaging, transport, wastage, distribution. Again, for everyone, it'll be different. If you're running a software company or data company, it'll be different, right? But broadly, this is just conceptually just to share that these are your cost of goods and these are just sales, general and admin expenses, right? Depreciation rates and your amortization. Most people don't have any amortization schedules, only depreciation. Debt, of course, what determines and the assumptions here are the principal, the interest, the tenure, and the moratorium, right? Again, conceptually, that's it. And tax payment depends on the prevailing tax rate, any benefits, perhaps MAT, perhaps a tax holiday as a DPIT startup, any carry forward losses, etc. Right? That's your P&L. Your cash flow is very similar, except you take your profit after tax, add back depreciation, reduce your repayments, and that's what you get, a free cash flow. For all practical purposes, for me, cash flow is the more important one, right? The profit after tax is an income tax. Is an income tax artifact. Cash flow is really tells you, does your business have cash? Can you do things with that cash, right? And there's many ways to raise this cash. Of course, it's cash flow from operations, cash flow from financing activities, and cash flow from other activity, which could be interest, etc. Right? So again, I won't get into all this, but these are really talking about the assumptions that you would need to, that you would need to consider when you do your modeling. I hope that helped. Good. All right. So yes, Kavita.
Thank you, Nalin. This was very helpful. It was a good sort of overview of, building your financial models and the explaining all the terms in it. I still do struggle with depreciation. We do have depreciation.
With depreciation. Okay, so I'll tell you a good way to think about depreciation. In fact, Shishti, as a CA, will have probably a better way, but let me try. So the way to think about depreciation is that everything degrades, right?
Yeah.
Your car degrades, right? Your desk that you're sitting on will degrade. Your laptop will probably become redundant in 2-3 years, right? So a depreciation is something that the government has allowed you to set aside for replacement of something that will degrade over time, right? So wear and tear is the term that accountants use, that everything will undergo wear and tear, right? Now, as a business, you are what is termed as a going concern, right? Going concern means you are an ongoing operation, you're an ongoing operational entity, right? And in order for you to remain a going concern, you always have to have certain things that help you do that business, right? Your desks, your laptops, your machinery, etc., right? So, and all of these have useful lives. They have useful lives, meaning after a certain time, they are no longer useful. Why? Because they either reach the end of their design or engineering life, or they reach, or they just break down and before the end of their design life, right? Now, similar concept is economic life, which is defined as part of the IT Act, right? So typically, you would say, okay, something has a 10-year life, right? It may actually last you 15 years if you take care of it, right? But at least on the books of your companies, every year using straight line, you'll set aside 10% of the, if it costs you 100 bucks at the beginning, you'll set aside 10 rupees as part of your depreciation schedule, and that'll come as a depreciation head, right? So you set aside that, and what that set aside means, it's come out of your taxable income. So you set that aside, right? So that's a benefit almost that the government gives you, to be able to set this money aside, because at some point you'll need to replace it, right? And the replacement cost maybe 100, maybe 110, maybe in fact 50 rupees, because there's technology development. But the government says, okay, whatever it was at the beginning, let's assume that you set that aside. So it's a replacement cost. Um, uh, 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 yeah, it's a replacement cost component, basically. That's how you can think about it, right? And the act of how much that depreciation should be is generally defined in the IT Act or in other kinds of schedules. So you don't need to get into that too much. You know, you can get someone who's well versed in it too. Or you think of it like that. You think of it as a set aside for replacement costs or a going concern.
We have a question from Meenu in the chat.
Yeah. You're right, Meenu. So startup revenue assumption or projection based on assumptions. Yeah. So exactly. So you have to make sure you're able to justify why you're saying my revenue projections are where they are, right? If you're in a business and you say, okay, I'm going to have 200% year-on-year growth, and you're in an industry where there's no historical basis or justification for that, right? It's going to be hard for you to justify that, right? So we are all, part of certain sectors where there's data available. Of course, you may be doing something very unique, in which case you may justify something that's not happened before, right? Airbnb, for example, did something unique when they were starting out, and they had to be able to justify their growth in the absence of a similar business model, right? So that sometimes is just something that that people will take a leap of faith and say, okay, I believe you. I can see the potential. I can see your ability to execute, and yeah, but you should have the ability to justify these. That's it. That's it. And assumptions will go wrong. It's not may go wrong. Even in the best of scenarios, they will go wrong. That's fine. But you just have to you can't be 1/10 of your projected revenue. That's a problem. You can't even be half, because that makes it a big problem. You have, okay, 10 plus minus 10-20% is something that we model when we do something called sensitivity analysis. What happens if this changes by 10-20%, 25%, maybe 30%, right? But it's very hard for you to imagine something going down 50% and less than 90%. So yeah, that's it. Okay, I think we are at the end of the session.
Okay, thank you so much everybody for attending. I will upload this recording tomorrow or by Monday latest. And yeah, see you in the next session. Bye bye. Thank you so much.
Thanks.